So we are looking at solving publication questions. Now, publication in the exams is 20 marks. But that 20 marks, it comes from various perspectives. Please confirm if you see my screen. Please, can you see my screen?
Yes.
All right. So this 20 mark can come from adjustments on draft retained earnings. Or retained earnings. It can also be the one of publication style that you just do your SPL and your SOFP. You can have that. Or it can also be a cash flow. So these are the areas publication questions can, come from. So you should be able to solve questions in these diverse areas to equip yourself for, the exams proper. Because we all know that in your exams these days, your question 1 is consolidation, a full one for 20 marks. Your question 2 is standards, also for 20 marks. Your question 3 is the publication questions. Your question 4 has been your ratios. So publication 20 marks, ratios full 20 marks. Then question 5 has now been, of course, you have some standards because the standards is supposed to be 25 marks. So you have another standard over there. Then you have, so there's a standard for 5 marks there. You have issues of governance for 10 marks. Then you have issues about the conceptual framework, ethics, like those things. Ethics and governance is 10. Then conceptual framework add up to the 5 marks. So when you are learning, situate your learning well. See, sometimes they even, because of this one, they will make it about value added statements. Value added statements. So you should have an idea about these varying areas. Now, what we are going to do is to look at this one. And whilst you are looking at this one, it automatically looks at this and the 5 marks here. All right, because you'll be learning the principles of the standard. With each publication, the principles of the standards will come out. All right, so let's take our first question and practice how these things will look like. So our first question is about the new Craig Hall, and it falls under this one, how to do the adjustments. All right, so that is that. But whenever you are solving a publication question, I have done a video on how to solve a publication question. I'll share it with you for you to start how to go around it. But so let's look at it. In the exams, you have 15 minutes to read. So you've seen that this one will be at your question 3 area. And so your job is to read through first. That's the first thing, read through. Okay, so you read, The trial balance, the draft trial balance have property, accumulated depreciation, equipment cost, equipment accumulated depreciation, financial assets, inventory, trade receivable, cash and cash equivalent, retained earnings, share capital, loan payable, trade and other payable. Then the draft profit before tax is also given. And that one, so you see the dates along with it, 2011, 2011, 2011. Then you go and check the requirement. It is also asking you to do something for the year ended 2011. So he has already given you the profit. In these types of questions, you have the profit, but the profit has some errors in there you are going to correct. That is the issue. So he gives you the relevant information that are available. You are going to use your knowledge about the standards to adjust the things. That's what this one is about. Your knowledge about the standard to adjust the things. You are going to adjust the profit because there are certain things that weren't done. That's your main job. And whilst you are looking at it, the standards will come out. So it says that the following information is relevant. On July 2011, don't forget your year ends in 31st December 2011, which means anything July means half year. From July 2011, New Craig Hall received 5 million, 8% loan. So you said you've not done financial instruments. So this will be a way to know your financial instruments. All right. So on July 2011, New Craig Hall received 5 million cedis, 6% loan note, which was accounted for correctly at that date. It is due for repayment on 31st December 2016. The interest is payable annually in arrears. The 5 million was used to fully fund the construction of a new building. So it looks as if it's taking another trajectory. Instead of IFRS 9, it looks as if it is bringing in another thing. Like he has taken a loan and he's using that loan to construct something. I mean, something should start popping up in your mind and we will look at it. The construction cost has been correctly capitalized, but no other accounting entries in respect of the property or the loan has since been made. The construction is due to complete 31st January 2012. All right. So that is the first thing we need to now look at. And so you are just reading. You are just reading to find out things that they didn't do, you will have to do. Because they've told you that they've correctly done some things. The part that they didn't correctly do is your job to do. All right. Now it says on December 2011, New Craig Hall placed an order for equipment at a cost of 3 million. The cost is included in the equipment. This cost was included within the equipment and trade payables. The equipment was received and paid for in 6 January 2012. Then the properties include land at cost of 12 million. New Craig Hall company depreciation policy is that property is straight line. Equipment is diminishing returns, which we call reducing balance. Right of use is also straight line. All right. Then 4, the financial assets. So clearly, this will be another standard, which is this is also a financial instrument. So we will use that one to go over financial instrument. The financial assets are 3% bond that were acquired for 3.5 on January 2011, and which New Craig Hall intends to keep until maturity. Transaction costs are 0.5 million were incurred. The bond were capitalized at 3.5 and the transaction cost was expensed. The bonds have effective interest rate of 7%. New Craig Hall company received an annual receipt of 105,000 on 31st December 2011 and recognize this as an income. Interesting. On January 2011, New Craigor entered into a 5-year lease for equipment. The equipment had a useful life of 5 years. New Craigor makes 5 payments of 2.4 on January each year, including the commencement date. Using the implicit rate of 13%, the present value of the future lease payment after the first payment was 7.139. The 2.4 paid on January 2011 was expense and no other accounting was performed. Current tax payable at 31st December 2011 was 680,000. In the financial statement for the year ended, New Craigor planned to disclose contingent assets of 1.2 relating to court case. On 30th December, a court ruled that New Craigor would receive only 1 million. No accounting adjustment has been made in respect for this. So your job is to calculate the adjusted profit. So you are going to do a statement for adjusted profit, then you do your balance sheet. So this is the first style of questions. And so that is the adjustment on profit. So in your exam sheet, you have 20 pages of exams answer booklet, 20 pages. You are supposed to use maximum 4 pages to answer a 20-mark question. Every 20-mark question, you have 4 pages to do that. So 2 sheets. So in questions like this, your first thing to do is to use the first sheet for your proper answer. The second sheet also for your, the first page for your proper answer, second page proper answer. Page 3 and 4 will be workings for your answers. All right. So take note of that. That is the best way to actually approach this. So when you have a question like this, that you need to adjust the profit because the profit has been given to you. So what you are doing is so let's do A. So you start by, of course, you need to state the name of the company, New Craigor. Then statement of adjusted profits for the year ended 31st December 2011. All right, then you put in your currency sign. So remember, at this level, we don't do 2 currencies, it's just one, right? So you will start with the draft profit before tax. Draft profit before tax. And that is 4420. So that is what you start with. Then you are now coming to do the adjustments one by one. The adjustments. If you have to reduce it, you subtract. If you have to add up, you add. So what you will be doing is to pick the notes one by one. Your workings will be labeled by the notes one by one. So that is done on the 3rd page of your work. So I'm going to go somewhere here and use this place as my page 3 for the workings. So the workings, we are going to label it workings 1. Workings 1 means note 1. So whatever we do, we get the understanding of that. And you will come and insert it into your financial statement. So basically, that is what you do one by one. You pick it, you come and do. You pick it, you come and do. You pick it, you come and do. So that is what happens. So the first one, on July 2011, Craig Hall Company received a 5 million 8% loan which was accounted for correctly, so we don't have a problem with the loan. It is due for repayment on 31st December 2016. The interest is payable annually in arrears. The 5 million was used to fully fund the construction of a new building. The construction costs the construction cost has correctly been capitalized, but no other accounting in respect of the property or loan has been made since that date. And the thing was completed on, the construction was completed on 31st January 2012. That's the next year. Now, my question to you is that which standard do you think this thing is about? Which standard? That's the first question. Which standard? Yes, which standard? When you look, you read it, what standard comes into your mind? Somebody collecting a loan, putting it into a construction. What standard is that? Any idea? Yeah, Hetty.
Investment.
Investment. Good.
Investment IS first.
Unfortunately, it's not so. This is
Oh,
borrowing cost.
oh,
IS 23. That's what it is about. So here, I now use this one to help you revise on borrowing cost. What is borrowing cost? Borrowing cost is the interest, all right, that you pay for taking a loan to finance an asset. That is what borrowing cost is about. So anytime somebody takes a loan or borrowed funds, so interest on borrowed funds for constructing a qualifying asset. Qualifying assets. That thing becomes a borrowing cost, the interest you pay. Now, you know that the recognition criteria begins with commencement. When do you start capitalizing? When do you start capitalizing borrowing costs? There are three conditions that must be met. Do you remember those conditions? Were you taught? So borrowing costs must be incurred, which means you have to borrow the money. Commencement. Now, expenditure must be incurred. You have to use the money. Must be incurred. 3, activities necessary to bring the asset to its useful state must be in progress. So that's the commencement criteria for borrowing costs. Then you talk about suspension. So this is how you are supposed to learn borrowing costs. So you talk about suspension. What do you mean suspension? Suspension is about anytime there is a break in the work or in the construction of the asset, and that break, the reason for the break is not part of the construction of the asset, then it means you need to suspend it. So when any break in work is not for the asset, we suspend. And I'll go deeper into this shortly. Then when do you cease borrowing cost? Cessation. You will stop capitalizing borrowing cost when substantial part of the asset is made ready for use. So this is something you must know going into your exams. Now, the reason for this sides and is measurement, because how do you measure borrowing cost? This is the formula. The interest rates, okay, multiply by the borrowed funds minus investment returns for from using the borrowed funds. All right, that is it. So that is that. But you see, interest rates are per annum. They are always per annum. Every interest is per annum. So you must check the time the borrowing cost commenced. See, all these three things must be met before you can start capitalizing the borrowing cost. Borrowing cost is part of the cost of an asset. So when these three things are met, you ask yourself, have they borrowed the thing? Have they spent the money? Is the activities in process? Once these three things are met, it means you need to capitalize borrowing cost. That means that the interest is not treated as an expense. The interest is added to the value of the asset, borrowing cost. But the time it commences matters. And when they suspend, you must also reduce the months. If they suspended for 1 month, you see, you can suspend. I'm saying when the suspension or the break is not for the asset. You know, sometimes when they are constructing an asset, it's good that they break for some time. That one, it is a technical thing the asset needs. So when they break, you don't suspend. But let's say the people went on strike. That one, you have to suspend because that strike is not to the asset's advantage. It is to the human being. So we are looking at those ones that is for the asset. If the thing is not in the interest of the asset, then you have to suspend. Then lastly, when they finish the project, it means that that one too, the job is done. You can't continue capitalizing the borrowing cost. So these are issues of the borrowing cost you need to know. These are issues of the borrowing cost. All right. So that is that. So you use this one to prorate the interest rate, the start time. That is it, the borrowed funds. And if they take the loan and invested the loan themselves, the interest they will also get from investing that loan, you will subtract it from your borrowing cost. So now, if you look at this part of the question, the reason why they gave you the date the construction ends is to help you calculate the months. And that is why they've given you everything. So now, you now need to calculate the months. And remember, your work ends in December 2011. You are preparing an account for 2011. So how much of this 2011, how much of this 2011 will go into this borrowing cost calculation that we want to do? So what is our interest rate? The interest rate is 8%. Is that not it? And looking at the borrowed funds, we still need to prorate because interest is rate times time times the amount. So how many months are we looking at? They started in January. Look at the period with which you are preparing an account. How many months will go in there? How many months? If you
6 months.
yeah, if you check the thing, the whole thing is like 7 months, is that not it? But
Yeah.
the period we are doing our financials, it is 6 months. So 6/12 multiplied by the borrowed fund of 5 million. That should give you. We don't have a situation where he also invested the money and got some return. So what will be our answer? What will be our answer? Quickly, quickly, quickly.
Oh, 200,000.
That's
Or I
200.
should convert it to. Okay.
Yeah, it's fine. It's just that we will leave the three zeros out because we have put three zeros on top here.
Okay.
Yeah, so we will be leaving the three zeros out. So this borrowing cost should be added to the cost, to the asset. It must be part of the asset. That's what borrowing cost is. Borrowing cost is supposed to be added to the asset. Now the question said that the construction cost has correctly been capitalized, but no other accounting entry in respect of the property or the loan. So it means they've not done anything concerning the loan. So it means that we have a loan of 5 million also to recognize in our books. So when we are doing the balance sheet, take note of that. So the loan of 5 million, in this case, like 5,000, will go to our NCL, and the borrowing cost to we have capitalized the borrowing cost. All right. So this is what borrowing cost is about. Interest added to the cost of the asset. Then the loan itself is a loan. So therefore, it must be part of our NCL. All right. So that is that. So basically, if you finish this thing, and there is some of the in the workings, there is an amount that is supposed to go to the P&L. You go to your P&L and you adjust it there. But you see, borrowing cost has nothing to do with P&L. Borrowing
Mhm.
cost is part of the cost of the asset. So it won't be part of, so we will rather be adding it to our asset, not in the P&L. So it won't affect our profit before tax. It won't. So you leave it there. But you see, when you add it to the cost of the asset, perhaps the depreciation is the one that will be treated in your P&L. All right. So take note of that. Take note of that. Okay. So that is that. So you are done with this one. You should remember when you are doing your balance sheet. Then you go to your workings too. Workings too. Now it says that New Craig Hall on December 1st, 2011, placed an order for equipment of 3 million. They ordered an equipment for 3 million. The cost was included within the equipment and trade payables. The equipment was received and paid for on 6th January 2026. 6th January 2026. Now, this one too, you need to ask yourself, which standard that this thing cover? Situation whereby somebody has placed an order for equipment at a cost of 3 million. And the cost has been included within the, it says the cost it was included within the equipment and trade payables. The equipment was received and paid for on 6th January 2012. Now, if you look at it, the 2012 is the next year. The
Mhm.
2012 is the next year. Do you see that? Our year
Yes.
ends in 2011. So to include, they ordered for it. and the thing has not come. And what they've done is that they have included the money in the trade payables and also within their equipment. What do you think is wrong with that? Do we record something based on an order? That's the question you need to ask yourself. You don't have an asset. The fact that you have ordered an asset doesn't mean you have the asset. Have you seen that? If we allow these things to be, then it
Mm-hmm.
means that if somebody wants to increase his assets, he will place an order. And because he has placed an order, he has not received the asset. Now, which standard do you think this thing is about? What they've done, which standard do you think is about? It's about IAS 37, provisions, contingent assets, and contingent liabilities. That's what the standard is about. What does it say? You see, it says that you cannot record a contingent asset. You cannot say you will have an asset and so therefore you have an asset. No. If I promise you, Hetty, that I'm going to give you 10 million, you can't say you have 10 million. No, you can't say that. So what will happen to this 3 million is that since they included it in the equipment, we need to remove it from equipment. So that will mean that we need to credit our equipment. But I'm not saying when you are solving the question, be writing the standard. So no, 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 no. It's because I'm teaching you. Then you debit your trade payables. This thing too has nothing to do with the P&L. So nothing goes there. So you are doing this thing so that when you start doing the balance sheet, you know the things that you are supposed to be doing. All right. Then workings 3 is for note 3. So for each note, you make the note the number. It makes the marking easier. Property includes land at a cost of 12 million. New Craig Hall depreciates. So it means now we need to do our PPE schedule. We need to just do everything about PPE. So what are the assets there? We have property. We also have equipment. All right. These are the few main assets. So we can get the costs. This one is 32,500. This is 16,200. If there is accumulated depreciation, you will less accum dip. Now watch it. The accumulated depreciation is at January. So it means you need to do for the year 2011. So this one is 9,200. This one is 8,420. All right. So strike it. Let's know our opening carrying amount. Let's know our opening carrying amount. Then we are going to do our depreciation.
For property, 23,000.
23,000. Exactly. It can be you. There must be, it's 300 is part, eh?
300.
All right. Then this one too.
7,780.
All right. So that's what we have. Then we need to now take away the depreciation. Now, this is where you have to be very careful. This is where the borrowing costing you did can have an effect. So you have to go back because we all know that they didn't add this 200 to the asset. But should we add it before we charge depreciation for the year or not? So that is a question we need to ask ourselves. Obviously, This one was done. This one was done in July. And the question said that it is due for the interest payable in arrears. The 5 million used for the 10 construction of the house. You know, the 5 million should be part, this one, the double entries. This one, not only should it be an NCL, it should also be part of the asset because you use the money to do an asset. So it should be part. Now, but the question said that the construction cost has correctly been capitalized. So they have done the asset part. That is what it said. It has correctly been capitalized. So that is what it said. So it means that we have done that part already. Okay. Then what they have capitalized is, and you have to be very, very careful about that part, because what they have capitalized is the loan that they used to build the asset. But they said no other accounting entry in respect of the property or loan. All right. In no other accounting entry. So what they did was, I said the 5 million used for the was used for the construction of the new building. The construction cost, which is the 5 million, has been correctly capitalized, but no other accounting entry in respect of property or loan has been done. If they had been done, why then, if they've done the 5 million, it means there's something they have not done. They have not added to the asset. So it means that is the part we are supposed to do, basically. So now, if you go to and so you need to be very careful about the depreciation. How you go about your depreciation. You need to be very, very careful about that. Yeah. Okay. So that is it. Now, let's come here. They've told you that the 5 million has been done inside. It's part of the asset. They've done that one. So the part they have not done is the part that we need to focus on and do. So we need to calculate our depreciation. Our depreciation. So here you need to be very, very careful. The question said depreciation for property is 20 years. So if we want the depreciation for 20 years, what will it be?
For 20 years, for property, we use the cost. The cost, that's 2,500 over 20 years.
Yeah, because it is a straight line method over
Yes.
20 years. What does that get you?
Okay.
But you need to be very careful. That's where the issue is. According to the
Okay.
question, and that is why publication is sometimes interesting. According to the question, they have done capitalize the 5 million in the thing. They have capitalized the 5 million. Do you realize that?
Yes.
But the 5 million, it came in which time? The-
July.
It came in July. So when you are doing the depreciation, you need to be very, very careful.
Okay.
Yeah, so the 5 million has its timing. They've included it. So if you pick everything and you do the depreciation on it, you may make a mistake.
Okay.
All right. So take note of that.
So does it mean I have to multiply it by 6 months?
Yeah, that will be for that particular part.
Okay. So with this one, it's 20 years.
Then I think we also read another thing somewhere about the lease. Where was it?
Five. Five.
Point
That's
five.
five.
Yeah, it says on January new entered into a 5 year. That one is for equipment, so that is not on the property. That one is not on the property. Okay, so it means that when you are doing your depreciation, this particular one, you just need to be
Mm-hmm.
careful to take the 5 million out because the 5 million came in July. If you take it and you just do everything over 20, you will not appreciate the 5 million, the essence of the 5 million. That's the point.
Okay.
So you need to take out the 5 million, all right? Then you look at it from, so divide these figures, take out the 5 million, all right? And the property, they also said that, was it a land? We we had a land. Where did we read that one? I think when we were reading, we read a land. Yeah, this is it. Property includes land of 12 million. And you also know that we don't depreciate land, right? So you need to be very, very careful. So your depreciation actually, this straight line method, and these are the trick in the exams. You have 3,000, 32,500. You have to take land out because we don't depreciate land. You also have to take the 5 million out for the construction because that one will also not suffer for a full year for now. Then you can divide it by your 20 years. So do it so that you can get the depreciation. Other than that, you may make a mistake of bringing everything into the thing. And you see, the thing about the 5 million is that you will start depreciating the asset when, and learn this now. We start depreciating an asset when the asset is ready for use.
Okay.
So you ask yourself, the 5 million, was it ready for use in the year? If you check it, they said that the construction was due to complete at next year. So if something is not
Mm.
completed, how then do you depreciate it? Have you seen that?
Okay.
All right, very good. So now get us the depreciation for this part. And that thing
Um,
will also affect our P&L. All right, let's go.
775.
775. All right, so that is that. So you see how tricky the question can be. Yeah, so
Mm.
take note of that. All right, so that is it for this one. What about the other one? So now the depreciation for the equipment too, you need to be very careful. The 3,000 they added, the 3 million. When did it happen? Fortunately for you, that one happened at the end of the year. Do you realize that?
Yeah.
Yeah, it happened at the end of the year. So on the equipment. But you see, it didn't really happen like at the end, at the end. It happened on 1st December. So if it happened on 1st December, you are coming to do your depreciation. So this one, the cost that you have, it is inside because it is on 1st December. That is, and this financial statement is as at December, this trial balance. So it means that that one, you need to be very, very careful. You need to take the 3 million that shouldn't be there out before you can depreciate that one. So if I want to help you better, we can decide to do it like this. Keep these figures. Say adjustments. Can say some, call something like some adjustment. Because we know we are deducting 5 million for this, which is not worthy of depreciating. No, let me do, because the land too is, we don't depreciate land.
Mm.
Yeah, but you note that one down because still you will not depreciate the land. So take the 5 million out and this one to take the 3 million out. So this is 4780. And what would this one be? Whatever it is, you will still not include the land. 23,300 minus 5,000.
18,300.
10,300. But you know there is land of 12,000 there. So
Yes.
depreciation will be minus 12,000. Depreciation will therefore be no, it is inside this one. Sorry. So our this thing was correct. We can just bring it back. So it's this 32,500 because it's straight line method minus 12,000 minus the 5,000 all over 20 years. We had 775, right? So
Yes.
that is our depreciation. And this one, what method? Equipment is diminishing return. So that one is straight. Do your 25% and let's go.
25 on the 4,000.
4,000, yeah, because it's reducing balance.
8 times. Reducing balance. 1195.
1195. Good. So that is what I have here. Remember, the 3,000 shouldn't be there. So it's not like we should go and depreciate that one differently. It can't be there. All right. So what will be our
Okay.
carrying amount?
Sorry, with the property. So
Mhm.
we are letting the 77 from the two
No,
three
from the
next 3,000.
18,300.
Oh, okay.
You meant if
20
you are
from five
lessing it,
to five.
we are lessing it from this one,
Yes.
right?
Yes.
Yeah, it's true.
Uh-huh.
It's true.
Two two
So
five two five.
yeah, so the way it is good you realize that. So if this side is not necessary, you just take it out. Yeah, because we didn't even use that. So
Yes.
you have
525.
22,525. All right. Then we bring in our borrowing costs. Remember, borrowing costs are meant to be added to the cost of the assets. They are meant to be added to the cost of the assets. So the borrowing cost, that is, we had what? 200, eh?
And 200.
Yeah. So is the timing that makes us not add the borrowing cost at the because the borrowing cost is something that is done at the end of the year. We did the 6 months, 6 months end at the end of the year. That is why we are not depreciating the borrowing cost also. So this one is 22,725. All right, that's your. What about this one? When we subtract, what do you have?
3585.
3,585. All right. So basically, that is that. All right. So, but what you've seen here is issues of depreciation. You just have to be careful. So now we know that we need to subtract from our draft a depreciation. You need to subtract. So where's our draft? So you are taking away depreciation. And the depreciation, we are left with another one, the right of use. So we will do that one quickly. So we have the property. You can even put it together and say depreciation of PPE, right? But we also have
Okay.
equipment, but we know we are taking 775 out of this. And the second one was 1195, right?
Yeah.
They didn't do it. We are doing it. But there is also another depreciation on the right of use. And we will go and do the right of use and come and clear the depreciation also for that. So that is workings 4. Oh, no, that's financial assets. The depreciation on the right of use, the lease is workings 5. But let's do our workings 4 first. So much time is done on the adjustment. When that one is done, the rest of the work is easy. So workings 4 is financial instrument, which you say you've not learned, right?
Yes.
So this is the time I use to help you revise on financial instruments. Now, financial instrument operates on the accounting equation. If you know your accounting equation, is asset is equal to equity plus liability. So we call this one financial asset. We make this one equity instrument and financial liability. How do we do financial assets? And I think your question here is about a financial asset. Now, the financial asset, what is a financial asset in the first place? It is any situation you have that gives you the right to receive cash. To receive cash. And this situation can be when you sell to somebody. So that is a trade receivable. So receivable is a financial asset. Any situation that gives you the right to receive cash. You can also be a shareholder. Do you know that one too gives you the right to receive cash? That is dividends.
Yeah.
Good.
Yeah.
So any situation that puts you the right to uh, receive cash, you can also invest in a bond, and that one will give you interest. Interest you received. So that is that. So in a financial asset, we have two categories. We have the one that you can get because you invested in a debt instrument. Why? That one is the interest you will be earning. And we have the one that we categorize as an equity instrument. That means you bought shares and you will be collecting dividends. Okay, so that is that. Anything that, any contract that puts you in the right to receive money or receive any other financial instrument is called financial asset. Now, the initial measurement. So, initial measurement. When it is a debt instrument, we have three initial measurements. First one, we call it the amortized cost. Second one, fair value through OCI. Third one, fair value through SPL. The equity ones, we have only fair value through OCI and fair value through SPL. Good. So these are the types of financial assets you can have. Now, when it is about these two, and I'll explain it later, you will see. The initial measurement is the fair value plus transaction cost. When we say transaction cost, that is any issue cost, any cost you will incur before you can have the instrument. So if you read this one, it said the financial asset are 3% bond which were acquired and which he intends to keep until maturity. The transaction cost is 0.5. Have you seen that? When it is about fair value through SPL, you only the initial measurement. The initial measurement is just the fair value. The transaction cost will be expensed. Transaction cost is expensed. Now, how will you know? So the question is, say, how will I know that in the question it is amortized cost? How will I know it is this one? How will I know it is fair value through? So this one that you read, how will you know that it is amortized cost? How will you know it is OCI? How will you know it is SPL? So let's learn that. Amortized cost. Hold on a minute for me.
Um,
So how will you know it is amortized cost? How will you know it's fair value through OCI? How will you know it is fair value through SPL? Please, this is the part you need to listen carefully because you can have a standard question that is about IFRS 9 financial instrument. You see, we use the amortized cost if the person is holding the bond till maturity. So there are two tests we use. The test we used here is the cash flow characteristics test. And the cash flow characteristics test means that the person will have two cash flows. One is the interest, two is the redemption. So when you invest money, you'll be collecting interest every month. And when the time of the loan to is up, you go and collect your interest plus your principal. The same thing for this one, cash flow characteristics test, also the interest and the redemption. But there is another one, we call it the business model test. Business model test. Now, the business model test, for the amortized cost, you hold it till maturity. Till maturity. So when you intend to keep the thing till maturity, it means it is under amortized cost. This one too, the business model is also till maturity. So the question is, say if this is till maturity and this is till maturity, then which one would this one fall under? Now you see, this one, it is till maturity. And nothing can cause the person to stop the investment. Nothing, unless you have problems of cash flow. You don't have money. So picture yourself going to do an investment. Your idea is that you will never touch the money. You are just earning the interest. If the money was invested for 5 years, it is at the end of the 5 years you go and take your money. That is till maturity. But this till maturity, this one, you will go and destroy it if you see another investment with higher return. With higher return comes up. So I equate this one to the ladies who are for money. When they are with you, they see another person who has higher money than you, they will drop you and go for that person. But these ladies, the amortized cost ladies, they are with you unless you, the guy, you mess up. Yeah. So when you see a question that uses they keep till maturity, then it means that you are going to go for the amortized cost. That is it. Even though this one is still maturity, they will stop when investment with higher return comes up. But the fair value through SPL people, you see words like they are tradable and they are also short term, like treasury bill. Treasury bill is short term, it's within 1 year. And they are also tradable, which means you can go there and stop it or sell it. Yeah. So take note of that. Now, when it is amortized cost, you come and do your table. Yeah. Balance brought down. Your balance brought down is the initial measurement, the fair value plus the transaction cost. Then you add the interest, implicit interest. Then cash received, how much you have received, and balance carried down. So this is it. If it is with fair value, after the balance carried down, the examiner will give you another fair value. So the difference between your balance carried down and the fair value he will give you at the end of the year will be going to your OCI. All right. That's why we call it fair value through OCI. So if you look at our question, our the initial measurement, therefore, will be how much? Fair value plus transaction cost. The fair value was 3.5. Transaction cost is 0.5. So we have what? 4 million. So you do 4 million. So here we do just 1 year. We do it for 1 year. Only we are interested in 2011. So at the end of 2011, we have 4 million. Then the interest rate here, we call it unwinding. So you do the implicit interest rate or the effective interest rates multiplied by the balance brought down. Implicit or the effective interest rate multiplied by the balance brought down. You'll be seeing two interest rates. But this side, you use the implicit or the effective rate. But the cash received side, you use the nominal plus multiply by the nominal value. So in our question, the effective implicit rate is what? 7%.
7%.
So multiply it by the balance brought down. But when you are doing it, always be careful the timing because every rate is per annum. Good for you. This one started in January. So it means it's full 12 months. All right. So go ahead. Let's have it.
280.
280. So you add it. Then you subtract the cash you have received. Now, the cash received is the nominal rate. The nominal rate is the one you always see here attached to the money. So even with this one, this would have been the nominal rate. So it will be 3% by the nominal value. Nominal value. What is the nominal value? When we say nominal value is just the loan amount. All right. So the amount you received every year. But this one, he gave you. He said he received an annual receipt of what? 105. If he doesn't give you, you will just be multiplying it. He will give you the nominal value and you'll be multiplying it by that. So, like something like this. This is the fair value, but he'll give you the value of the loan. And so he can say that they acquire something that was 4 million at 3.5. That means that the nominal is the 4 million. And how much they actually pay is the fair value. So take note of that. So they receive interest. Sometimes this interest, you will find it in the trial balance. They will do interest, something interest, and you will see it. Sometimes you will not see it in the additional information. You will see the interest in the trial balance. All right. So what will be the balance carried down? That'll be 4 million minus 0.105 plus 280. I have here 4175. So since it is not OCI, we don't need this part. So what do? This interest will go to the P&L. This one to go to the SPL. All right, so that is it. Then this one will go to the balance sheet, NCA. This is an asset, so non-current asset to go to the balance. So when we go to our P&L, we need to go and add the interest we have collected, interest received. Interest received. You need to go there and add. Interest received. Which is 280. The effective interest is 280. And the nominal interest, the cash that you receive. So this is it. Where is it? Yeah. New, and recognize this as income. This is what they did. So look at it. The bonds the bonds have effective rate of 7%. Newcastle have received, New Craig Hall received an annual receipt of 105,000 on 31st January and recognize this as an income. That is not the income. The income is this one. Interest income. Unwinding interest income. That is what we call it. So this one that they recognize should be corrected. We need to, they rather added that one as the income. So let me call this one the effective interest so that you will know. Effective interest or unwinding interest. So the one that then the interest that they did, which is the other interest, the nominal interest, we need to correct it. They added it before, but that shouldn't have been the one. So we need to take it back. It was an income, so we need to take it back. So that is that. That is that. So these are things you need to take note. Instead, that money is a cash flow. This one is goes to your cash flow. This is it's about cash flow. It has nothing to do with your P&L. This is the one that goes to SPL, and this will go to your NCA. So take note of that. So you will be working the thing one by one, and you'll be correcting it. Now we will be left with workings 5, right? Workings
Yes.
5. Then it says that new Craig Hall on January 1 entered into a 5-year lease. As for lease, you've done lease, right?
Yes.
The equipment has the useful life of 5 years. New Craig Hall will make 5 payments, 2.4 each year. So at the beginning of each year. So that means that this is a lease in advance. No lease, you need to have your right of use. You need to have your lease liability. All right. And you do the lease liability first. So this question
Mm.
says New Craig Hall will make 5 payments, 2.4 each year, including the commencement date, using the implicit rate 13. Present value. There's a present value of future lease payment after the first payment. Watch it. That means that the first one, if the first one is out, the remaining that you are having here is 4 years because the thing was 5
Mm.
payments. So after this one, so after the first one, so it means the 4-year lease payment, the one that is left is what you have as 7.139 million. So that would be something like this, 7.139. So he has done that one for you. And he says that the 2.4 paid on January was expense. You can't expense that one. That 2.4 paid in the first year is not an expense. So it means since they treated this as an expense, they subtracted it from our income. We need to go and add it back. It's not an expense. It's part. It is payment on commencement date.
Mm-hmm.
So it's supposed to be here, 2.4, 2,400. Then you bring the PV of the lease liabilities, which is 7139. That is what it should be. So since they treated that thing as an expense, we need to go and add it back. So lease liability, what do we call it? Lease payments. All right. And it was 2.4. So add it back. So you'll be correcting the mistakes that they've done. All right. So all these things, when you do, for example, if you write this one, you go to, let's say, workings. What did we use? Workings 3. The exam, so that the examiner will know. This one was workings 4. Workings 4. You'll be putting it there like that. All right. Lease payment. We are working it at workings 5. All right. So that is that. I'm sure the depreciation too definitely will come via workings 5. So this is how you go about it. You show those things. All right. So that is it. So your lease liability total is this one, but the assets, what is the value of the assets? Add it up. That's like 9,500.
9,539.
All right, good.
Nine
So that
five
is it. So
three.
now we can depreciate this one. What's the useful life of the lease? 5 years. 9,539, 5 years. Depreciated. 5 years.
1907.8.
Can we round it so that we will tell the examiner everything is to the nearest whole number?
Okay. 1908.
1908. Okay. So what is our right of use?
7631.
7631. All right, that's fine. Okay, so that is that. So this part is done. We know that we need to now do the subsequent measurement for this one. We've done the subsequent measurement. So the depreciation is 1908, right? So the depreciation we were waiting for here is 1908. So we will take away the depreciation. We will just do the subsequent measurement for the liability. So that one you always have to do 2 years so that you can have your lease liability done. So always remember to do 2 years. So this lease happened on 1st January. So you do 2011 and 2012. Start with your balance brought down. Balance brought down is, what's the lease liability? 7139. This is in advance. And when it is in advance, payments come before interest. But the first year payment will be dash. Remember that, because the
Yes.
first year they've already paid at the beginning to be dash. So you bring your subtotal. That's how we do lease in advance. Then the interest will now come. What is the effective rate? 13%, right?
13%.
So do your 13%.
928.
928. Then you'll get your balance carried down. So how much is that? You just add them.
8067.
8067. Good. So you continue. 8067. The payment this year is 2,400. So then you get the rest to do the interest. So this interest too will go to the SPL. So get me the others.
5667.
5667. This will be our NCL. Go ahead.
The interest is 737.
All right. Then when you add up, what will be your
6404.
6404? So this is it. This one will go to your NCL. And if you were taught that the difference and this one will go to your CL, it is the same as the difference between this one and this one. All right. So yeah, so when we are doing the balance sheet, know the things. But for now, we need to take our interest. This is a lease. So we need to go and subtract our interest from our P&L. All right. So the interest is 928. We need to go there and subtract interest 928. The thing is that if you don't do the adjustment, well, your balance sheet will never balance.
Okay.
Interest on lease payments. So we have 928 we need to subtract. Good. Good. So that is that. What else is left? Current income tax is 680. Have you done tax?
Um, yes.
So working 6. Tax. So we have the tax, we have two of it. We have the current tax and we have the deferred tax. The current tax, you need the accountant, the entity's estimate for the year. Then you add under or over provision. When it is over, you subtract from last year, from the previous year. So when it is under, you add. When it is over, you subtract. Then you add movement in deferred tax. The movement can be positive or can be negative. So the total here will go to your SPL. Now, this one, you will see it in the footnote, the entity's estimate. The estimate, you see it in the footnote. This over and under adjustment, you will see it in the trial balance. Now, when it is under, it means it is at the debit side of your trial balance. When it is over, it means it's at the credit side of your trial balance. So take note of. Then the movement in deferred tax is done here. You need the balance brought down. Then you will calculate your balance carried down. Now, how do you calculate your balance carried down? It is the tax rate multiplied by temporary difference. And if there is any revaluation surplus, you add. So let me do it like this. Revaluation surplus. All right, so that is that. If there is no revaluation surplus, don't bother yourself. If the revaluation surplus is not supposed to also suffer deferred tax, don't bother yourself. But how do you find TD? TD is the carrying amount minus the tax base. All right, the carrying amount of the assets minus the tax base. So in this question, the movement in deferred tax is the difference between this one and this. So this is the movement. The difference is the movement. But the movement, be careful. If there is revaluation surplus goes to OCI. So you do the tax rate multiplied by the revaluation surplus. That one will go to the OCI. Then the difference left out of it will go to your SPL. All right. So this is the template for tax. I would advise that as for tax, whether you like it or not, it will be in your publication. So you can go to YouTube and do IAS 12 Thomas. It's just 29 minutes video. You understand this whole thing. All right. Now,
Okay.
in this one, you have the current tax is there. It's 680. The estimate for the year is 680. So here, our estimate is 680. This one, too, this estimate, you will see it in the footnote, but it also goes to your current liability. Take note of that. And this one that you calculate will go to your NCL or NCA. If it is deferred tax assets, that means this side is negative. All right, so take note of that. Now, the one that they've given us, the estimate is 680. That's the one we have, is 680. Let's go to the trial balance. If you will see any over or under provision of tax, that is if there is anything tax. There is nothing tax, so this is dash. And there is no movement in deferred tax. There's no deferred tax also here. So that one too is dash. So it means our 680 will be the one that will go to the current liability. And that same 680 is the tax in our SPL. So when you go there, you tax it. You tax it. So let's tax. We need to pay tax of 680. All right, that's all. Then the last one, which will be our working 7. This thing contains a lot. I'm not sure your examiner will try, but it is to help you appreciate these types of questions. Some of them are even more difficult than this. In the book, in my FR book, there is a question called, I think, is it Havingford? It's like that, Havingford. All right. So this one, it says that in the financial statement for the year ended 2011, New Cracor planned to disclose a contingent asset relating to a court case. On December, the court ruled. Now, if the court has ruled, then it doesn't become contingent anymore. They ruled in December of our year. And they ruled that Craig Hall would receive 1 million. No accounting adjustment has been done. So it means that we need to do it. That 1 million that they will receive is a receivable. And at the same time, an income, because they are going to get that money. So in our SPL, we need to add it to our income. So that is it. I think that ends the note. So income from court case, 1,000. So let's get our profit. Our profit after tax now. The one that we are going to use to do our balance sheet. Then we can go and start our balance sheet.
Two five zero nine.
The total,
Yes, please.
2509. All right. So that is the figure, 2509. Normally, I would want a second person to confirm. Robert, if you can confirm, because if that figure is wrong, we will suffer for our balance sheet. Because this one is supposed to go to our balance sheet as well.
Yes, please. I had the same.
You had the same thing.
Yes, please.
All right. Okay. So now let's go and do our balance sheets and wrap it up. So statement of financial position. As at 31st December 2011. And we have new Gregor. Balance sheet 2 is with 1. All right. So that is that. So now let's start with our NCA. Start with our NCA. All right. So the NCA, we had it listed for us already. We had the PPE. So you go to your PPE and you have the workings number. Let's go and get it. We also have what a right of use. We had a right of use like that. Let's find it. And we also had a financial asset, right? This will be our asset. Also a workings number. So let's find them. PP was which workings? Workings 3. And what did you get? So as for the PP, carry one figure to the place. So add these two. These are our carry number. So add the 2 and let's take it straight.
Two six three one zero.
26310. All right, then The right of use was workings number 5. Then the financial asset, which financial asset was workings number 4, right? Yeah. Hey, what is this? The transaction cost was expense. The bond were capitalized 3.5, and no, then it means we didn't do something. I told you, if you check what I discussed with you, you only expense the transaction cost when the thing is a fair value through P&L. Do you remember? Now, if it is fair, then and the expenses, then it means they shouldn't have expensed it. So it means we need to go back and adjust. Wow, that's interesting. You see, transaction cost was expense. You can't expense when it is, you rather add it to the fair value. So if they expense it, then it means we've made a mistake. Can you correct that one? Add 500 to it. Because you can't expense it. So reversal of transaction cost expense. If they deducted, we need to add it back. It shouldn't be there. Add 500. Will I make it 3009? What will it
Yes,
be?
3009.
Yeah, it can be that they expense it. So please be watchful, all right? You can't expense when it is fair value through OCI or fair value through P&L. You can't expense. All right, so take note of that. So what were we even looking for? The financial asset, right? Question workings 4. What did we have? 4175. So take note of that. And the liability 2 is what? The right of use asset 7631. So 4175 7631. I want my black. 4175 7631. So that is our current asset, the non-current asset. Then let's come to the non-current assets, if any. We have inventories. Nothing, no adjustment on inventory. So that should be straightforward. So that is inventories is 46. $4640. Then what else? Trade receivables. Also, there is no adjustment. That makes our work easier. That is 2810. Then the last thing we did, the working 7, right? We have a receivable again of 1,000. So let's call that one receivable from IAS 37. So let's call that one in. Let's say other receivables, because it's coming from the contingent asset they did, which we now reclassify. So you can say you can also call it reclassification of contingent assets. So that one is 1,000. Yeah. Any other cash and bank? No, that one is a overdraft. It's on the credit side. Okay. So can you total your assets? Total assets. Remember, balance sheet is done as asset is equal to equity plus liability. So let's go and do the equity side to see what we can have. So total the asset for me. Let's see what will happen. When you are done, I will share you the board. For each question, I will share with you the board for your revision.
I had 46,566.
46,566. All right.
Confirm.
They confirm. Good.
Yes.
46,566. Anyway, when you are in the exams and you don't get it balanced, don't kill yourself. The what you should be focusing on is to be able to do more of the adjustments. All right. So that is the one that gives mass. So we have equity share capital is there. Share capital. That is 14. Right. The share capital. Then you have retained earnings. Retained earnings. What is the opening balance of the retained earnings? Opening balance 12,620. Then what we had 3,009, right? You add your 3,009. So get that one for us. Then you can go to your NCL and the CL. The NCL, we have the loan, right? The loan payable. The one that's there's one that is loan payable is 5,000. Then we also have from the lease. So the borrowing cost is done here. Then the lease liability. The lease liability we had. What was the workings for the lease liability? The NCL for the lease liability. This is it. 5,667. Then CL, of course, you have trade payables. The trade payables that they included some money we worked on. They included some money in the trade payable that shouldn't have been added. We worked on that. So how much is that one? Did you even do a workings on that? The trade payable, there was a 3 million B they included. So let's do it here. The trade payable is 5,780 minus that 3,000, the contingent thing that they did. So that would give us 2,780. All right. Then we have also our unwinding. The unwinding finance cost from borrowing costs. That one was 200, right? So everything is double entry. And anyway, in accounting, when you do additional information, it's double entry. So this one that you did is also an unwinding, the one that you capitalize. As this one go to NCL, which you saw here, is there already. NCL, so this one was to go to NCL and also the assets itself. The unwinding finance cost goes to the asset and also the CL. All right. So that would be 200. 200, which we've done. So just have to put the workings number. This one, lease was what workings? 5. Okay. So that is it for this part. Then what else? Have we missed out anything yet? Have we missed out anything? Tax, eh? Overdrafts, which was 210. Then the tax. Tax. Tax was how much? The one we did. So if you don't take care, you miss out. But if you add and it's not balancing, you know. You have 680. All right. Have we missed anything? Add it up. Let's see. So give us this part, total your equity. This one, is it 15,609 or something? Or 3,000. So 15,629, right?
Yes, please.
Yeah. So total that side. Here will be 9, here will be 2, here will be 6, here will be 9, here will be 2. So you have your equity. Asset is equal to equity. So total this side, let's see if it will balance. If it doesn't balance, find the difference. I think if we have made something, you will know. Is that okay? So find the difference.
Let's move on.
So total the liabilities, all the liabilities. You can total this one first, which will be 66710. Then you add it up to this one and total everything. Let me help you with the calculation. So I have 10,667 plus 2,780 plus 200 plus 210 plus 680. I have 14,537. If I now add it to 29,629, it gives me 44,116. It's not balancing. What is the difference? Maybe we made something. 566, 2,400. Which one is that? Yeah, yeah. Go to the lease. The lease. I think that's it. We were supposed to do this one.
Other income.
No, this one. The current liability.
The current
No.
liability, yes.
Yeah. We've not added it. Lease. Liability. Oh, 2,400. So that makes everything there. So it was 14,537 plus 2,400. So here is 16,937 total liability. So equity plus liabilities. That is 46,566. All right. So you see the journey is not a small journey. It's not so usually when they bring this type of question, students struggle a lot. Where they've given you the draft, sometimes it's even retained earnings, not this one, the draft profit. Sometimes you'll give it to you as retained earnings, so you put it there. then you'll be making the adjustment on it one by one, one by one. And if you are not able to make the adjustment well, it will put you into serious trouble. But your job is to do as much of the adjustment as so if you pick every note, you analyze the double entry there. Remember, all footnotes are supposed to have double entry treatment. One item, something will affect the P&L, something will also affect the balance sheet. So you have to be doing that thing, this side and that side. All right, but please, for the purposes as this thing is an intervention, there are certain standards you can't afford not to learn. One of them is PPE. Whether you like it or not, it is part of your publication. Two is IAS 12, taxation. Whether you like it, it's always there. So try and get that part. Then you must abreast yourself with standards like IFRS 16 and 9, because you saw this one, both of them was there. Whether you like it or not, in your exams, it will pop up. Then do 15 so that you'll be able to recognize your revenue well, because that one too is there. So there are certain standards, whether you like it or not, you must learn them. You don't have a choice. So better learn them. Better learn them. As we were doing, you saw that IFRS 9 financial asset popped up. So from here, you should be able to know that financial asset, we have a financial asset when you buy a debt instrument and a financial asset when you invest in equity. Usually in your exams, it is the debt one that will come, a financial asset, FR, debt. So, but if you get the liability one, the financial liability too will come, whether you like it or not. So learn financial asset, learn financial liability. You have much time. Once again, if you do it in class, you still don't understand, the videos are there. So if you check, I should have done this thing long time. There are certain standards I need to give you videos for you to watch before an intervention meeting, because whether you like it or not, those standards are there. And you saw the tax, you saw this one. All right, so that is it. Okay.